Financial Accounting, Chapter 8, Receivables, Part 2 of 3. So this is the meat of Chapter 8, where we're going to talk about the different methods of calculating the allowance for uncollectible accounts. Remember that uncollectible accounts are also known by the name of doubtful accounts and bad debts. This term is used interchangeably with all companies. So let's talk about the allowance method required by GAAP. GAAP says that if you're a company with a large amount, a substantial amount of accounts receivable, this is the method you have to use to estimate your bad debts. It's a key word I just said. You have to estimate your bad debts. You can't just wait until an accounts receivable becomes uncollectible. You have to estimate this amount in advance. So this is required by the matching principle. So that's why matched is put in bright red there. Losses from bad debts are matched against the sales they help produce. That means that if you sell as a company $1 million during a year and you think that of the accounts receivable you have, a certain amount is not going to be collectible because that's what you found historically, then you have to make an estimate. It's a professional estimate. It's based on facts from prior years. It's based on what's going on with the economy. And it results in an adjusting journal entry, remember what AJE stands for, that's made annually. It's made by the accounting department and management as they sit around the table and collaborate to determine what do we think we're going to have to take a hit on. And it is a bad hit as an expense. What do we think the expense of estimating bad debts is going to be? And because of matching and because of GAAP, they have to record this. Now, when do they record adjusting journal entries? That's an important concept to remember. AJEs are recorded at the end of the accounting period, and they are recorded right before financial statements are prepared to ensure that the financial statements are accurate. And GAAP requires accurate financial statements done through the allowance for uncollectible accounts expense estimate. So we have this new account called allowance for uncollectible accounts. It is a contra account, a contra asset account. That's key for you to understand this chapter. It is an asset with a credit balance. It's a new type of term, a contra account. It's netted against accounts receivable and reduces accounts receivable to the amount that they really think will be collected, considered to be the net realizable value. So if we look at this example, let me get my highlighter up. If we look at this example down here of the allowance for doubtful accounts, again, remember that's another term. It can be uncollectible or bad debts. Then we find if accounts receivable in this example are $67 million and you have an allowance account, a contra account of $2 million, then that means that the net realizable value of accounts receivable, also known as the net accounts receivable, is $65 million, and this is the amount that the company expects to collect after all is said and done. If they could move fast forward in history, they assume that $2 million is not going to be collectible. This is not unreasonable, unfortunately. Companies, for example, let's take one that I use frequently in a face-to-face class, and that is John Deere. John Deere finances most of their sales. They have billions of dollars worth of accounts receivable, and they have to estimate how much they think will be uncollectible. And they do so every year. And every year you can find out what their net realizable value of accounts receivable is. It's also frequently known as the net accounts receivable. Make sure you understand this slide before you move forward. So if you need to rewind and listen to the content on this slide again, there's just so much important information here before we go forward. Okay, so let's look at the allowance method for uncollectible accounts with an example. Extone Company has accounts receivable of $200,000 and estimates that $30,000 will be uncollectible or at some stage in the future go bad. Again, remember, this is the matching principle. They say, sorry, you can't wait until the future, you have to record that now. And let me get you to pause for a minute and think about it. The matching principle says revenues and expenses should be matched in the correct period. So if a business has a current balance of $200,000 in accounts receivable, they have to do an estimate of how much of that they think will be uncollectible. Again, it's a cost of doing business, and it's an expense, and it accurately shows the users of the financial statements what their net income is, because it's going to include this large expense. If they waited until this $30,000 estimate came true down the road, then it would be in the wrong period, and it would throw off the accounting records of future years. So what's this adjusting journal entry look like? It's a debit to bad debt expense matched with the revenue of the period, and it is a credit to the contra account, yes, to the contra account called allowance for doubtful accounts, again, also known as allowance for uncollectible accounts. So I've asked this question down here. What is the net accounts receivable? And in this example, if we have this much in gross receivables and this much in our contra account, you just simply have to subtract, and you'll see that the net accounts receivable in this estimate are $170,000. Another quick pause, just for those that aren't familiar with the difference in gross and net. Most people have had a W-2 before, and they know that their gross pay is greater than their net pay because something's been subtracted out. Of course, we know that's something to be taxes. Gross receivables of $200,000 are less than net receivables of $170,000 because something has been subtracted out. And that something in this example is the bad debt expense. As a final reminder for this slide, this company doesn't know, they do not know which accounts are going to be uncollectible. They've got to make an estimate, a professional estimate, and we'll see next what we do when somebody actually doesn't pay, when we've estimated an account receivable to be uncollectible. So let's look at this example of what happens when you finally know that someone's not going to pay you. So in this example, Xtone writes off $26,750,000 worth of uncollectible accounts. They're not estimating, they're writing this off. So this is another little trick that confuses and trips up a few students. So what we've got in here is this estimate that we made. $30,000 is our estimated allowance. It's a credited asset account because it's a contra account. And this company has determined that $26,000 is going to be uncollectible, and they've shown this as the total accounts being written off as $26,000. And in this example, they're going to debit the allowance and credit accounts receivable. Take this accounts receivable completely off of their books. And there's further and more detailed illustrations in your text. But they're going to debit the allowance to show, yep, out of the $30,000, we have $26,750 that we've had to write off because we've stopped trying to collect them. We maybe sent them to collection agencies. We've done everything we can. We stopped trying. And this leaves an unadjusted balance at the end of the year of $3,250. So a few comments here. First of all, remember, it's an estimate. So this $30,000 was an estimate. Our estimate was wrong, as estimates often are. Only $26,750 was determined to be uncollectible. So we now have a balance in our allowance for doubtful accounts of $3,250 because we incorrectly estimated. It is extremely unlikely that a company is going to be able to estimate exactly the amount of accounts receivable that they're holding that will be bad, that will have to be written off. But again, last time I need to say this probably, Because of matching, because GAAP requires the matching principle, because of accrual accounting, an adjusting journal entry has to be made that shows the amount. Okay, let's look at how these estimates are done. Because normally it's based on experience and industry averages and forecasts of the future. And for those of you that recall the recession of 2007, 2008, companies were having to write off a lot of bad debts because the economy was doing poorly. Whereas in current periods, we're finding less amounts of estimated uncollectible accounts. So there are two methods. These two methods are crucial to understanding Chapter 8. We'll take the easiest one first, and then we'll move on to the second. So, percentage of net sales. Let's take this information where we've got this amount in our accounts receivable. We've got this $3,250 credit from the prior period because, again, you're never going to get this exact. We have credit sales of $3 million, total credit sales, and bad debt as a percentage has been estimated. This is a huge management estimate right here. Management has done this through what they've noted in the past, what typically happens. It's almost like you making an estimate of how long it takes you to do your homework. This is an estimate of what they think bad debt as a percentage of credit sales will be, and it's 0.75%. Or and so you can put that in as 0.75% or 0.75%. So using the percentage of net sales method, which is the easier of the two, if you do a problem or if you're out in industry, you'll find out what the total credit sales are. You'll multiply it times that percentage, and you'll come up with 22,500 for this example. Just as a reminder, it's 0.0075. So this fourth of a percent is 0.0075. And let's look at what the adjusting journal entry is going to look like then. Once we've calculated that 22,500 by taking the 3 million times 0.0075 here, you might want to check that on your calculator because I find many college students still have challenges with ratios and percentages. And if you put 0.75 or 0.075, you're not going to come up with the correct amount. It's 0.0075 to get 3/4 of a full percent. That's less than 1%. So this adjusting journal entry is the same that we memorized, and it's important that you memorize the debits and the credits pieces of this. We have bad debt expense here, and we credit the allowance for uncollectible or doubtful accounts, and the amount is $22,500, and that's the debit, of course, and the credit. And this is what it would look like if you had the T account. $32.50 left over from the prior period. This is our beginning balance. Adding to that $22,500, and that's equal to $25,750. So the current balance is $25,750, and you can calculate your net realizable accounts receivable if you need to. Before we try one, I want to pause for a minute. I'm trying to backtrack a little bit to give you some insight onto how all of our dots are being connected. As we learned about T accounts in Chapter 2, and as we learned about closing entries in Chapter 3, the allowance for uncollectible accounts is a contra asset. It is not closed. So this beginning balance right here is left over from the prior period. So last period's ending balance becomes this period's beginning balance. And now we add this adjusting journal entry so that our balance sheet shows the uncollectible estimate. And this is going to become next period's beginning balance, and we'll have to show our write-offs throughout the year. And so it's going on as a cycle, and that's why we. And as always, I try to encourage each of you to work on this problem before clicking forward and before forwarding the video to see the answers. So assume that we're doing for the Miley Company an estimate of bad debts using the percentage of sales method. It can be sales or net sales. And if you listen to the Pencasts, you'll see a couple of problems found on SitLearn. Net sales are $400,000, and the company decides that 2% are estimated to be uncollectible. So I've got this recorded as their entire sales have not been collected. Accounts receivable are $400,000, net sales are $400,000. We have a beginning balance of $300,000 in our allowance for uncollectible accounts. And what I'd like you to do is either to write these T accounts, the best practices would be to write these T accounts on a piece of paper to show the debit and the credit recording the 2% estimate of uncollection. So take a pause, write these numbers, come back and I'll show you the answers. Okay, hoping you took that pause and calculated what it's going to be. The answer would be 8,000. That's 400,000 times 2%, 0.02. And you debit uncollectible accounts expense, and you credit the allowance, and now the allowance account has an $11,000 balance. My suggestion would be that you try your homework at this stage for the percentage of sales method. If you're trying to figure out which problems those are, look in the back of your textbook, ebook, or hard copy, and see the problems that relate to this method, and try them out now while it's fresh in your mind. It's the best way to enhance retention of knowledge. Okay, moving on to the second method, the analysis of receivables method, sometimes called the aging of accounts receivable. This method is based on the assumption that the older an account receivable, the less likely it's going to be collected. The analysis of receivables method sometimes is called the balance sheet method because you're looking at the balance sheet accounts receivable, and you're trying to see how much is going to be uncollected based on how old it is. And this requires an adjusting entry that adjusts to match with what the accounts receivable aging chart shows. So you've never seen an accounts receivable aging chart, but there are businessmen and women every single day that do nothing but analyze these accounts receivable aging charts to see what's going on with their sales collections. So here's what one looks like. Maybe some of you that have worked in accounts receivable in a company or have worked for any type of small business have seen an aging chart. The best thing I can help you with is to suggest that you look at a doctor's bill. Frequently, whenever you receive the bill in the mail, they will show how old your accounts receivable is. And that's what this is doing. First, it's a listing of all the customers totaling 240,000. This is just a partial listing. These things can be pages and pages, or of course alternately screen after screen on the computer. And this shows that of 240 accounts receivable, they have 125 that's not quite yet due. And then they show the age of how many days past due it is. So if you look back here, there's $14,000 of this company's accounts receivable that are over a year old. And the older the accounts receivable is, the more likely a company is to find that they're not going to receive the money. And that's pretty clear here. They think they're only going to get about 20%. They've estimated 80% to be uncollectible. And this is a professional judgment. Accounting is full of professional judgments. And as a result, down here, we have through each one of these columns showing the number of days past due, including items that aren't past due. What we show is a sum of $26,490 that we have estimated based on an aging of receivables. So for this company, if we use this second method, this analysis or aging of receivables method, then we will find that we are going to target the ending balance. And this is so important. We're going to target the ending balance of $26,490 because it came from the prior chart. If you need to go back to the prior slide, do so. The aging of accounts receivable chart showed an estimate, a professional estimate of $26,490. But since we've already got 3250 in here, we're just going to do whatever it takes to get us up to speed, and that is to increase this account by $23,240. So our ending balance comes out, as we estimated from the aging chart, to $26,490. Okay, one thing you probably are going, wait a minute, I didn't pay any attention to the beginning balance under the percentage of sales method, and that is true. Each of these methods has a different format. Can be confusing, something that has to be remembered. After the entry is posted, as I showed on the prior page, the adjusted balance is $26,490. The entry is only going to be $23,240. The bad debt expense is only going to be what we need to make the account match with what we found on our aging of accounts receivable chart. So let's try one. In this example, the Usher company uses the analysis of receivables method or the aging of accounts receivable method, and they have determined that $20,000 is uncollectible based on an aging chart. It's an assumption that this $25,000 came from an aging chart like the one we saw for the prior example. $500,000 in accounts receivable. We've got our sales recorded here, and there is currently $5,000 in our beginning balance left over from the prior period. Record the entry required, and I will suggest that you pause, calculate this through T accounts on a piece of paper for best practices and retention. Okay, $20,000 is our uncollectible accounts expense, and $20,000 will pull us up to the $25,000 here. That is the estimate that we were given here. And of course, if we were to say what is our net accounts receivable, then we would take accounts receivable, subtract out the 25, and we'll find that our net is $475. Again, that's $500 less the 25. So, what if I were to ask you to record this in a journal entry form? And what if I were to ask you to give me the formula for calculating the net receivables? The $475 comes out as 500 minus 25. It's the total balance in the contra account. And the adjusting journal entry will be to debit uncollectible accounts expense for $20,000, credit allowance for uncollectible accounts expense of $20,000. And your explanation is that you're recording the uncollectible accounts for the period. I didn't have space, but in a real journal entry, you would put more details. You would show that the estimate was for $25,000 based on the aging chart, and you would show the method that you were using. Long video, thank you for sticking with it, and this concludes part 2 of 3. This is, as we said earlier, the more complicated concepts that were found in chapter 8.